Today I want to show you a strategy that could potentially give you a 50% return within 10 days, 50% on the cash that you invest into this particular deal. So I used a stock option strategy for this, and I used it on EWZ, which is a Brazil ETF. For those of you who are new to my channel, this is my daily trade log, and this is my trade number 238. What I did with EWZ, or what I normally do, is every single time the price goes below 28, I like to sell put option because it's quite predictable. It would at some stage bounce back above 30. So that's how I have been making a fair bit of money trading EWZ. But this time I wanted to do something different. I was banking on the price bouncing back to $30. So I applied a calendar spread by selling a February $30 put option and purchasing the January $30 put option. And currently the mid price is about 175. I purchased it for 183. And if we look at the volatility between these two expiration, then you can see that the February is at 39.6 while the June is at 37.8. So barely any difference between the two. And if we go back to the daily chart, then we can see that the volatility over here on the lower lines, the green and the red line indicates the volatility, the low and the high. We can see that the volatility is quite low. The IB rank is at 26.5. So if the volatility goes up, then I will benefit greatly from this deal. Another thing to notice is that because I sold the $30 put option, the intrinsic value is $1.50 because the current price is 28.50. So the difference between 30 and 28.50 is $1.50. So that's my intrinsic value. And I sold this put option for about $1.64. So my extrinsic value is 14 cents. So it's not much. But if we look at the analysis, then we can see that if the price remains at 28.50, then at expiration, so let's just check. I am setting this to show me or evaluate the potential profit at expiration on the 17th of February. Then we can see that if the price remains at this level, then my theoretical or my potential profit is 47.20. But if my assumption will be correct and the price goes back up to $30, then I could potentially make almost $100 on this deal. So in other words, I invested $183. I could potentially walk away with $283. So that's a significant return within 10 days. And my maximum loss on this deal is the money that I invested, which is $183. But I know that I will not lose that much money, even if everything goes against me, because I can still roll my February expiration to March and collect additional premiums so I can bring down my cost basis. And then from there, I can roll again to May. And then from there, I can roll again to June. So I have plenty of time to be right with this trade. And every single time I roll, I can expect to get additional credits. So that would reduce my cost basis. To recap, to purchase a calendar spread, it's a debit transaction. It takes cash away from you rather than giving you cash. Normally, option traders sell options, so they collect credits and they collect premium. But in this instance, this is a debit trade, so I had to spend cash on it. But I can reduce the amount that I spent on it by rolling my position if needed. However, once again, if everything goes according to my plans and the price bounces back, then I should be able to make a significant profit on this deal. So this wraps up my trade number 238. I hope you find that useful. I hope you find it beneficial. If you like it, please hit the like button and subscribe to my channel and spread the word and trade options. Thank you for watching.